Alrighty, folks, my brain is a block of fried cauliflower. I thought, let me go ahead. Let's have some fun here today, okay? Let me put a presentation together. So I've been putting together this for the last few hours here and share this with you guys so you can have fried cauliflower for a brain as well, okay? There's so much conflicting stuff going on in the stock market right now. So many things are seen as bad that could be potentially good. So many things are seen as good that could be potentially bad here. And so I wanted to run through all this here today. We'll go through all this and I'm going to share my perspective on all these different things that absolutely, no doubt, these things can affect the stock market. It's important to understand why and how they do. So yeah, hope you guys enjoy this as always. And also thank you FTX for being my official crypto partner. If you guys want to check out FTX, create an account, check out the pinned comment down there. Actually, it'll be the first link in the description down there. Basically, buy crypto with no fixed fee. It's pretty awesome. Use the code HolySmokas as your referral code and get a free coin when you deposit $10 and trade with that, okay? All right, guys, so first thing up here, United States unemployment rate, right? It's been incredibly low recently in the threes, which is historically like insanely low. Anytime under 4 is just ridiculously low for the unemployment rate. Now, this takes you back the last 60 plus years. And what you're going to find is every single time we dip below 4% for our unemployment rate, very shortly after you have basically a skyrocket up in the unemployment rate. And it's kind of natural, and we'll go through this here in just a moment, but it's kind of natural and it kind of almost makes sense, right? At some point, the economy just seems to get maxed out, right? And it seems like everybody that possibly wants a job can get a job, which means you're pretty much at the top. And the only thing that can happen from there is things get worse. And so that's just kind of how it is, right? It's like you're at level 100 and you have to come down and come down and come down. It's just a matter of like how much you come down. But if it's as good as it gets, it's as good as it gets. And what we've seen throughout economic history is you reach that stage of it's as good as it will ever be, which is usually unemployment rate under 4%. And shortly after that, you go through some sort of recession. Something happens. Next thing you know, unemployment climbs. Then it ends up peaking out and it starts to drop. And then you get back under 4% again. And then you repeat this cycle. And it's like an ongoing cycle every single time. We've never seen it throughout history where it hasn't been that cycle. And so you can get an unemployment rate under 4%, but usually it only lasts maybe a few months. I mean, you'd be lucky if it lasts like a year. And that goes throughout history. Every single time you drop under 4%, look at that. Skyrocket up right here. You're under 4% for a pretty good amount of time. That's probably the longest stretch we ever had under 4%. And boom, then a skyrocket higher. 4%, skyrocket higher. Right here, under 4%, skyrocket higher. 4%, skyrocket higher. 4%, obviously this one was due to Rona, so that's kind of like an insane one there. And this was prior to the Great Recession. It didn't look like we got under 4% there, but we got pretty darn close, and then we skyrocket higher. So every single time you reach these periods where, it seems like it's as good as it gets, and next thing you know, unemployment climbs. Now, right now, unemployment being so low is kind of a good thing for the stock market. That means people have jobs. They can go out there and buy all the stuff. They can go and, buy the new iPhone and order a bunch of Amazon stuff and order a new Tesla and all the companies that are the big market caps they can spend at those companies, right? And think about even like a company like Microsoft. They benefit huge by all the business creation and formation and those sorts of things. But this is kind of bad news though, because likely, it's just like a ticking time bomb here essentially, where all of a sudden unemployment will end up skyrocketing back up, and the next thing you know, it's going to be all of a sudden unemployment rates of 6%, 8%, something like that, right? If you look at wage growth, so wage growth has gone insane recently. I mean, wage growth typically is anywhere from 2 to 4% throughout time, and especially since I've been in the stock market, which I got in the stock market 2008, 2009. That's when I started paying attention to all this money-related stuff, right? And like 2% to 4% was the norm. Recently, we're up near 7%, and I don't think that's going to go down in the short term. If anything, that's going to keep climbing over the coming months, right? And so you're at this time period where it's like, okay, that's great. Wages are great right now for workers, so they can possibly spend more money. But on the flip side, this is going to kill companies' profitability, because like if you think about what goes into a business cost from a cost percentage, a huge amount is payroll, right? For a typical business, they pay out 20 to 30% of gross revenue in payroll expenses. And so you're talking about one of the biggest, if not the biggest expense for most companies is payroll, right? And so if you're talking about everybody's wages are going up, that's less profitability for companies. That's less EPS for companies. And remember, the stock market trades a lot of times based upon PE, forward PE, those sorts of metrics, profitability, right? Because that's what people want. They want the profits at the end of the day. And so if you're in a market where companies' profitability is being hurt in a major, major way because employee costs is rising substantially, wages, bonuses, all that stuff is rising quite substantially, then companies just have way less profits at the end of the day, right? And so this is absolutely something that matters in a big, big way. For one of the biggest companies in the world, one of the biggest market caps in the world, Amazon, they've seen this. You guys have probably seen the headlines. This is from a couple months ago. Amazon more than doubles max base pay to $350,000 for corporate and tech workers, citing labor market. And I can tell you guys, all the biggest of the big companies have been having big labor issues, right? Where they need to get a lot more workers and wages are going up quite substantially. Silicon Valley is about the most competitive. Everybody's stealing workers from everybody right now, essentially. And you have companies like Meta that are just trying to way overpay versus what the market's at right now. So Meta's attracting a lot of the best talent right now. When their stock price is down, so a lot of folks are saying, hey, maybe I'll go over to Meta because, if they go on a beast run over the coming years with the stock options, you can make a lot of money. But number two, just honestly, they're paying way more, like 20 to 30 to if not 40% more depending upon positions than a lot of other Silicon Valley companies are paying. So if Meta keeps stealing away employees, Google has to raise. Google was always known as like one of the best, if not the best places to get the most pay, right? Even Google's now starting to become like employees are mad at Google because they feel like they're not getting enough pay at Google. When that starts to happen, you got wage concerns, okay? And then Apple says, okay, well, now we're losing people. We got to bump up pay. And so you have this kind of war going on of like employee talent, and you have an extremely tight labor market right now, which is not ideal for companies that are competing for workers, right? And so this is obviously a huge, huge situation. And you go even a deeper level. This was from September of 2021, right? Amazon hikes average U.S. starting pay to $18 an hour, hires 125,000 people. And that's one of those things that I wouldn't be surprised if it goes up again and again, at least in the short term, right? Until we have any sort of major pullback in employment. And so you think about all the jobs Amazon supports. If you even talk about raising wages $1 to $2 for those employees, that's a massive cost increase. Talk about $3 to $4 per hour. Talk about $4 to $5 per hour. And so this is a big, big deal. And this is why, it's great that people can make more money, but also remember all the people that are renting, that are seeing their rent costs go up 20, 30, 40% year over year. Well, shoot, if your wages went up 6%, 8%, that's not cutting it. And so these companies could continue to have massive wage pressure on them for a while, which could end up making these companies pull back, unemployment going higher, which would be good for the cool down of wages, because if you have a lot more employees, you don't have to be as crazy about raising your wages. But this is one of those conflicting, contradicting points right now, right? Speaking about conflicting contradictions, let's talk about the Fed, right? And so the Fed's now in this place where they're raising interest rates. We all know this, right? And they're going to likely continue to raise interest rates. But why are they raising interest rates? Well, there's two core reasons, right? Number one, the Fed's only going to raise interest rates if they feel the economy's strong. Right? Like really, really strong. Otherwise, they're not going to risk it, because otherwise you risk putting the whole country into recession, right? So they have to feel like the economy's in a really, really stable place, which they clearly do right now. And when you have unemployment under 4%, wages going up, you kind of have to do that if you're the Fed, right? Number two is because everything's been skyrocketing in price, they're trying to bring down inflation. And so one of the only tools they have at their disposal is raise interest rates. And hopefully you can cool the housing market, you can cool other things, right? And so the Fed's raising rates. That's good because the economy is good, but that also is a risk, because if they keep raising rates, then, debt markets could start to dry up a bit. People aren't going to be as likely to take out loans, which slows the economy. If everybody has to pay a much higher interest rate on their Tesla, then not as many people are going to order that Tesla, right? If credit card payments interest goes up even more, that's not a good situation. If you're talking about mortgage rates, which we're about to get into here, keep going up. There's not going to be as many people buying houses, because houses are already getting super unaffordable. Never mind, you tack on huge interest rates, that you have to pay on that. It's just, you can't afford that house literally anymore now at this point in time, right? The 30-year mortgage rate tops 5%. With the Fed continuing to raise rates, the mortgage rates could continue to skyrocket up for months and months to go in the future, if not for this entire year. You could easily see 5.5%. 6% mortgage rates this year, like literally this year we're in right now. And those are rates we haven't seen in long, long time. And so if you're talking about homes at record pricing, and you're talking about the highest mortgage rates we've seen in, 15, 20 plus years, That's a horrible situation for the housing market. And so that's what you should worry about. And the housing market is so big, and we'll get into that in just a moment here, but the housing market is so big that if you were to actually collapse the housing market, and let's not even say collapse, but slow it in a major way, you gotta understand, that's a massive amount of jobs would be lost, right? It's also a loss of confidence if people's homes, let's say, start to go down in value, right? And that would obviously not be a great situation for confidence for folks that own homes. But you look at something like this. Imagine how many jobs are affected by how strong the real estate market is right now, right? Which the real estate market is as strong, if not stronger, than we've ever seen at any point in given history, right? It's definitely up there. And so right now, think about all the folks that build new homes. Think about all those construction jobs, right? From the roofers to the people that are putting up the wood, to the people that are doing the foundation work, to the folks that are putting on the finishing touches of these homes, the painters, the folks that do the tile work. Think about how many just pure construction jobs come from basically new homes being built. That's an insane amount. Like these, between all these, this is millions and millions and millions of jobs. Think about all the raw materials, all the manufacturing. Think about the company that builds those garage doors back there, right? Think about the company that builds the windows. Think about the company that sells the locks for the doors. Think about all these different, things and these are all businesses that if real estate was to dry up, if new home construction was to dry up, let's say, in the back half of this year, especially as you go into 23, right? Because a lot of people have put in orders for homes in the past. What if those orders aren't starting to come in, starting this summer? Then all of a sudden, next thing you know, 23, you start having these companies having to cut back, start cutting jobs left and right? Think about all the real estate agents, the brokers, their assistants, the folks that work for these folks, right? Think about the folks like myself that, I used to be in the real estate marketing business with photography, videography, those sorts of things. Think about all those jobs that end up starting to be cut. Think about the mortgage and refinance companies. A lot of these companies have already started to cut jobs because refinancing has dried up massively now because everybody that already refinanced over the last 2 years, and mortgage rates are skyrocketing right now. So if you're a company that is in the refinance category, you're cutting jobs right now. You're not adding jobs. Literally in a matter of a year's difference, right? A year ago, you were adding jobs like crazy. Now you're cutting jobs like crazy, if anything, if you're in that game, or you're going to lose a ton of money, right? Think about all the folks that are remodeling their house, putting in money toward their house in that frame of mind because they're looking and they're like, real estate's been going up a lot. My home's worth a lot more now. I can remodel that house. Think about all those jobs that folks are doing, right? Think about the landscaping companies for front yards and backyards and how many jobs are created during that, right? Think about, companies like the lumber liquidators, Home Depot, Lowe's, furniture companies like the RHs, all those companies that obviously support a lot of jobs because we've been in a very, very hot real estate market. And if all of a sudden that real estate market starts to cool massively, you're not going to need nearly as many workers. That's just how it is, right? And then there's just so many random jobs in there that, this is, all I do know is this is millions and millions and millions and millions of jobs. And if you talk about a housing market that let's just call it cool substantially, all these people aren't going to need to be needed. That's just the bottom line in 23. And so you could end up going into a situation where starting in the back half of this year, you start to see actually go from these companies, a lot of these companies go from adding jobs to subtracting jobs and cutting jobs. And that's a real risk to not just real estate, but to the entire economy. Okay. This is something very, very important to kind of keep in mind there. Okay. Now, if you look at the big banks, conventional wisdom usually tells you rising rates. A lot of people think that's good for the banks, right? And that's always been like conventional wisdom since I got into the market, like, if rates are going up, that's good for the banks. And that's something you've taught in like Econ 101. Well, I don't know about that. I just honestly don't know about that, okay? You look at a company like JP Morgan, right? This stock's down 22% in the past 6 months. The biggest of the big bank out there, JP Morgan, big dog. The most well-run bank, in my opinion, in the United States of America and in the world, honestly. Goldman Sachs would be number 2, right? And they're more in the investment banking game. But you look at the stock and you say, what does Wall Street know? What does Wall Street know? So they got to know something here. Like everybody knows about JP Morgan. JP Morgan is Wall Street. Let's make that very, very clear. JP Morgan stock is Wall Street. So what does Wall Street know that this stock is down 22% in the past 6 months? Little fishy here. Goldman Sachs is Wall Street. Goldman Sachs stock is down over 18% in the last 6 months. These aren't small moves. These are massive moves. So you get this interest rates going up, and yet JP Morgan, Goldman Sachs are doing bad. These stocks are Wall Street, man. And they're not doing well. They're not doing well at all. And you got to ask yourself, in a red hot economy like we're in, and these stocks not performing well, what do they know? What do they know? That's a good question, okay? Now, there's some good news here, right? You want to talk about conflicting stuff, corporate taxes. So corporate taxes, there's a lot of talk basically in 2021 about corporate taxes potentially going up. I can tell you all of that talk has died down in a massive, massive way. And the reason being is, I think the administration, a lot of folks are looking at these companies and thinking, man, they've been reporting some really good earnings, but with wage increases, the massive inflation going on, a lot of this talk has died way down in terms of the tax increases. And the more and more you have to worry about, definitely, corporate taxes is going to be kind of put on the back burner. And this was something that, if you want to talk about something that was definitely worrying the market, corporate taxes going up, if you're talking about corporate taxes going from 21% to, let's say, 28%, that's a 7 percentage point difference, right? So that's 7 percentage points that companies don't get and Uncle Sam gets at the end of the day. And that would be obviously negative for companies, right? Because that's 7% less money that can go to the shareholders in the form of dividends, or the companies can use to buy back shares or whatever, right? So when they cut corporate taxes from 35% to 21%, there was a huge boom for company earnings overnight, right? That's 14 percentage points basically overnight that companies got to keep rather than Uncle Sam taking that money, okay? And so this has died down in a massive, massive way, which is good for the stock market. And, because if the companies just aren't quite having those nice increases in EPS, I think, corporate taxes are going to be like, we can't really raise these babies right now, okay? It would just be a bad timing when it comes to that. Bitcoin. So Bitcoin, this is another conflicting thing that's good and bad, right? Bitcoin's been chilling for a while, and it's actually down massively since the fall time, right? And so if we pull up a 1 year, Bitcoin's down 27% here. And when it comes to Bitcoin, the fact that Bitcoin is not in a hype cycle right now is kind of good news for the market, because crypto can kind of compete with the stock market sometimes for excitement. And Bitcoin doesn't have the excitement right now. But on the flip side, there's no really wealth creation being created from Bitcoin right now. So you can say, well, this is, if there's more wealth creation, more folks could take some of that money diversified in the stock market, right? And so this is one of those things that's like good and it's bad at the same time. But Bitcoin's just been chilling for a while. Now you pull up this. This is the latest numbers out of the AAII investor sentiment, right? And this is how investors feel the market will be over the next 6 months. And I was pulling this up a lot in March because basically these numbers were skyrocketing down. And I think it was the week of 3/9, I believe it was. There was only 19% of investors were bullish on the stock market, which was around the lowest we've seen in any time in recent history, essentially. And so recently, investors haven't been bullish on the stock market for the next 6 months. And this still is the case. You look at the latest week, less than 25%, less than a quarter of investors are bullish on the stock market over the next 6 months. Now, this is once again a conflicting thing, right? Because on the good side, or let's talk about the bad. Let's always get in the bad first. The bad side is, that just means investors aren't excited to buy stocks right now. If investors aren't bullish over the next 6 months in the stock market, most investors aren't going to buy stocks, right? And we could call them investors, traders, whatever you want to call them, right? For somebody like myself, if I see a stock that's a great deal that I love for the next 3 to 5 years, right? I buy that stock. I don't care if I'm bullish or bearish on the short term or anything. That doesn't matter to me. But I'm a minority in the stock market. Most people don't think like I think in the stock market. Most people are thinking, I don't know about this next 6 months, so I'm not going to invest in the stock market right now. I'm going to pull back money in the market right now. I'm going to sell, right? And so you can get a big amount of selling pressure on stocks if people just aren't bullish on the market. Now, that's the bad side. On the good side, you flip that over and you say, okay, if so many people aren't bullish on the stock market right now, then as a contrarian, you can look at that and you can say, well, that's a perfect time to be buying stocks. You want to usually, like historically, if you look at the past 100 years in the stock market, usually the best time to buy stocks is when no one's bullish in the market, right? They leave you a lot of upside potential. And usually the worst time to buy stocks is when everybody's bullish on the market. That means usually you're in some sort of bubble scenario in the market, right? And that's usually a time period where you either want to think about selling, or if you're not selling, then not putting new money into the market, essentially, and kind of cashing up, as I like to call it, right? Cash up in the market. So this is once again just another conflicting point we're seeing in the market, where it's like, okay, do you take the contrarian view and say, okay, a lot of people aren't bullish right now, so it's a perfect time to be bullish? Or you say, well, a lot of people aren't bullish, maybe they know the market's going to just continue to get worse and worse over the coming months, right? Now, inflation, everybody's favorite subject recently. Inflation's the highest we've seen in decades, literally decades, okay? Inflation's gone crazy. We all know that. Now, if you think about this for a moment, inflation, it hurts people's pockets, right? So people have to pay more for everything, right? Which means they might have less money to spend other places. But you also think about this on a corporate side, and you think about, let's say you sell a box of diapers and you get an extra $2 for a box of diapers than you did last year. Well, that's $2 more of revenue you have for a needs-based item. But then you say, well, how much of that is extra profitability? And you can get in all this like back and forth and like, is it a legit price increase, or is it a price increase because you just can do price increases right now, right? Because inflation's been so high and everybody has an excuse to raise price right now. That's a whole confusing situation there. But when it comes to inflation rates, it hasn't been this high in a long, long time, right? But on the flip side of this, what I will say, and I've been saying this, is I've always said this summer, right, we would see the rate of increase in inflation start to slow. That doesn't mean inflation starts going from like up 8% to all of a sudden like negative 8%. That doesn't mean that at all. What that means is inflation, I think we're right around peak inflation in terms of the rate of increase right now, okay? And I think it's going to all of a sudden start to hit like a 7% number from like an 8% number, and then 6%, then 5%, then 4%, then 3%. So although there's still inflation going on and things are getting more expensive, that rate of increase slows substantially. Okay. And that's the most important thing to remember when it comes to inflation, kind of my opinion on this. And I would say where there's a high probability we'll end up seeing that as this year kind of transpires on. Okay. And so that comes to inflation. So inflation is going to go from a situation where it's like awful to it's going to become a better and better story where folks are going to say, well, yeah, inflation, things are still getting more expensive, but they're not getting nearly as expensive as far as the increase as they were in the past, right? So that's something important to remember, right? Then you look at something like Apple, right? The big dog in the stock market, the one that drives the S&P 500, the one that drives the NASDAQ more than any other company, right? This is a stock that has held up tremendously well. It's up 30+% in the past year, right? Now, the issue with Apple stock, the big dog, is it's had a lot of valuation pull forward. The P is trading, at 28 plus. It had a huge Mac and iPad pull forward, obviously with everybody being at home for an 18 to 20 month span there. A lot of folks also started working from home. Their kids started going to school from home, things like that. And so the Mac and iPad business actually saw a huge increase, basically from about mid 2020 all the way through about the end of 2021, essentially, right? And the problem with Mac and iPads is most people don't upgrade those until like 3 to 5 years down the road. So if you had a big pull forward in demand, then you could be looking at a few years that all of a sudden the numbers just aren't quite there in terms of growth there, okay? And on top of that, Apple obviously launched their 5G iPhone. That's going to go on its third year starting in September, all right? The 5G iPhone was the last big thing to happen to iPhone since they made the big iPhone, right? The one that was an increase in size, which was, I think, back in 2014 to 2015 or something like that, right? I think it was 2014. And so here you are with Apple. The next iPhone's not going to have anything big coming in it, so you're not going to have some sort of hype excitement cycle there. You had pull forward in demand. You had a pull forward in valuation. And what does that mean for Apple stock? I think it's questionable, and we know there's no massive product coming for Apple, at least this year, and so that's kind of leaves you in kind of no man's land when it comes to Apple. I mean, this is the big exciting thing when it comes to Apple for the next iPhone generation is they're supposed to have a faster charge for your iPhone. Okay, cool. I don't know if this is going to be one of those things that makes everybody that is on the sideline when it comes to iPhone say, I got to go get the newest iPhone. Oh my gosh, I can't believe they're doing this. That's just not the way it works, right? You got to have something really game changing to make a lot of those folks that don't usually upgrade every year say, I got to go get that newest upgrade. And so that's a tough thing about iPhone this year from all the leaks and everything we've seen out of here, right? So that's a whole concern for itself when you talk about the big dog kind of being in a question mark for the next couple of years. Yardini, out of Yardini Research, if we look at valuation metrics, I've been speaking about this for months now, probably 6 months now. Mid caps are trading insanely cheap. Small caps are trading insanely cheap. The issue is I've been talking about this for like 6 months now, okay? At some point, this is forward P's. At some point, we're going to have to come back to a reality, right? But I've been talking about this for 6 months. I could be talking about this for 6 more months. That's the thing you got to understand. It's like you never know when you're going to get that big move up. And so at some point, smalls and mids are going to move. We just don't know when the heck it's going to be. And so this is just a situation here where, very rarely small caps and mid caps are ever trading this cheap. We know it has to come up in a more normal range, but we don't know when the heck that's going to happen. Okay. And so That's just an important thing. It's like, it's good to feel like you're way undervalued in the market, but at the same time, you could stay down there for many more months to go in the future. We just don't know when things are going to transpire there. And so that's why my brain right now is just a block of fried cauliflower, because I'm looking at all these different data points I just showed you there, and I'm like, we got so many good things to be excited for, but we also got so many things that on the flip side are bad, and that's why I would call it probably the most confusing time I've ever been in the stock market, guys. Hope you enjoy this as always. If you want to sign up for FTX, check out the first link in the description down there. Much love. Thanks for sharing a video like this with me, guys, and being part of this. I appreciate you guys as always, and have a great day.